Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 121. And in this episode, we are reviewing the performance of the global markets during the 33rd week of 2024, and that is from Monday the 12th to Friday the 16th of August. And without further ado, this is your host, Jamuhuri, and together, let's dive right in. We kick it off in the United States, where on Wednesday, the Bureau of Labor Statistics released a report showing that the rate of inflation in the month of July rose in line with market expectations, and that in turn raised the prospect that the Fed will indeed cut interest rates at its next policy meeting in September. The Consumer Price Index, which is a broad-based measure for the prices of goods and services, this increased by 0.2% on a month-to-month basis and by 2.9% over the past 12 months, down from 3% in June, and this was the lowest annual rate since March 2021. Meanwhile, the Core Consumer Price Index, which excludes volatile food and energy prices, this came out at 0.2% on a monthly basis, whilst the annual rate increased by 3.2%. And in related news, the Producer Price Index, which measures wholesale inflation, increased by 2.2% on an annual basis, which was a sharp drop from a reading of 2.7% that was recorded in the previous month of June. Moving over to the United Kingdom, data from the Office for National Statistics showed that inflation in the UK rose to 2.2% in the month of July, which was slightly below market expectations of 2.3%, but was a tad bit higher than the 2% that was recorded in the months of May and June, which was in line with the Bank of England's target rate. Meanwhile, the Core Consumer Price Index, which excludes volatile food and energy prices, this came out at 3.3% on an annual basis for the month of July. Staying in the United Kingdom, on Thursday, the Office for National Statistics revealed that the UK economy grew by 0.6% in the second quarter of this year. This reading was in line with market expectations and follows an expansion of 0.7% in the first quarter. The data confirms that the UK continues to rebound from a shallow recession that was recorded in the fourth quarter of 2023. The British economy has recorded slight but steady growth for almost every month so far this year. On Wall Street last week, U.S. stocks rose on Friday, closing out the best week of 2024 as the market recovered from a dramatic sell-off that happened on Monday, the 5th of August. The global sell-off was sparked by fears of an upcoming recession following a weaker than expected jobs report and was further exacerbated by the unwinding of the yen carry trade after the Bank of Japan unexpectedly hiked its policy rate to 0.25%. On Friday, the S&P 500 added 0.2% to 5,554, whilst the Nasdaq Composite also gained 0.2% to 17,631, and the Dow Jones Industrial Average rose 96 points to 40,659. For the week, the S&P 500 added nearly 3.9% for its best week since November 2023, whilst the Nasdaq gained 5.2% and the 30-stock Dow advanced by 2.9%. For your information, the carry trade refers to a trading strategy where an investor borrows a low-yielding, that is a low-interest rate currency like the Japanese yen, and reinvests the proceeds into a higher-yielding currency like the US dollar, or assets with potential for higher returns such as stocks. In the U.S. bond market, the yields on U.S. Treasuries were lower on Friday as investors digested the latest batch of economic data and considered the state of the U.S. economy. The latest inflation data came out in line with market expectations and cemented the view that the Federal Reserve will indeed cut interest rates at its next policy meeting in September. Investors are now looking ahead to the Fed chairman's speech at the annual Jackson Hole Symposium that is scheduled to take place this coming week, and investors will be focused on the outlook for the U.S. economy, but most notably the pace and sequence of upcoming rate cuts. In response, the yield on the benchmark 10-year Treasury bond ticked lower by 4.3 basis points to close at 3.88%, whilst the yield on the policy-sensitive 2-year Treasury note dipped by 4.9 basis points to settle at 4.05%. For your information, the Jackson Hole Economic Symposium is an annual conference for central bankers where they discuss the major issues facing the global economy and provide an outlook for economic growth as well as monetary policy. In the commodity market, the price of crude oil fell more than 1% on Friday amid reports that Qatar had requested Iran not to attack Israel during the ongoing ceasefire talks. After the first day of the Gaza ceasefire talks, the Prime Minister of Qatar requested Iran's leadership to de-escalate the tensions as they were making progress in the negotiations. The U.S. benchmark West Texas Intermediate crude ended the week slightly down by 0.25% at $76.65 per barrel, but on a year-to-date basis has gained about 6.9%. Meanwhile, the global benchmark Brent crude gained marginally by just 0.03% and was trading at $79.68 per barrel, but on a year-to-date basis was still ahead by about 3.4%. Despite the rebound in the U.S. stock market, commodity prices have tumbled over the past month, signaling an underlying weakness in the global economy. Even though the U.S. economy remains on solid footing, the commodity markets appear to be telling a different story about the global economy, and this was evidenced by the Invesco DB Base Metal Fund, which is down more than 7% over the past 1 month, whilst crude oil futures declined by about 14% during the same period. In the precious metals market, on Friday, the price of gold soared to an all-time high as the dollar weakened on growing expectations for an interest rate cut in September and as tensions in the Middle East bolstered demand for bullion. After hitting a record high of $2,500 earlier in the session, the price of spot gold registered an increase of 2.6% for the week before eventually settling at $2,493 per ounce. In the global headlines this past week, for the first half of 2024, Norway's sovereign wealth fund posted an astronomical profit of $138 billion. For the first 6 months, the fund posted an overall return of 8.6%, and this was primarily driven by robust returns from its investments in technology stocks. The Government Pension Fund, which is the world's largest sovereign wealth fund, said it had a value of about $1.65 trillion as at the end of June 2024. And on that note, we now change scene to the Kenyan financial market, and we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling was relatively stable versus the US dollar, and according to data obtained from the central bank, the official exchange rate for the US dollar was quoted at 129.20 compared to 129.41 the previous week. However, in the interbank market, commercial banks were selling the US dollar within a range of between 131 to 133 shillings. The lowest rate was offered by Stanbic Bank at 131.20, whilst the highest rate was quoted by NCBA Bank at 132.50. Meanwhile, the sterling pound was priced at 165.93 and the euro was valued at 142.27. And on the regional front, one Kenyan shilling was changing hands for 28.83 Ugandan shillings and 20.90 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.22. The shilling now appears to be relatively stable against the US dollar. However, that does not negate the fact that Kenya's underlying economic fundamentals remain extremely weak. And this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. And given these fundamentals, I expect that the shilling will continue to remain under pressure for the foreseeable future until such a time that we get our national debt under control. But as we all know by now, there are no solutions to excessive debt, just consequences in the form of higher taxes. On foreign exchange reserves, Kenya's usable foreign exchange reserves declined by $24 million to $7.31 billion, which is equivalent to 3.8 months of import cover. This level of reserves falls below the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and this is further exacerbated by our ever-increasing national debt that has pushed the country to the precipice of a sovereign debt default. On diaspora remittances, the inflow of remittances in the month of July totaled to $414 million compared to $378 million in July 2023, which was an increase of 9.6%. The cumulative inflows for the 12 months to July 2024 remained steady at $4.57 billion compared to $4.07 billion for a similar period in 2023, which was an increase of 12.2%. The inflow of remittances continues to support the country's current account as well as the domestic foreign exchange market. The United States remains the largest source of remittances into Kenya, accounting for about 52% of the total remittances that were received in the month of July 2024. In the money markets, during the past week, the interbank market was sufficiently well funded and was also supported through open market operations. The interbank rate, which is the rate that banks lend to each other on an overnight basis, this declined marginally by 29 basis points to 12.84%, down from 13.13% that was recorded the previous week. And in terms of volume, the average value that was traded in the interbank market decreased to 28.3 billion shillings, down from 33.1 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement, this stood at 10.8 billion shillings. For your information, the cash reserve is a statutory requirement that specifies a percentage of total deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 15th of August, and the central bank received bids totaling 25.7 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 107%. The central bank ended up accepting 25.6 billion shillings, and the results of the auction were as follows. The 91-day rate dropped by about 1 basis point to average out at 15.80%, whilst the 182-day rate dipped marginally by less than 1 basis point and came out at 16.70%, and the 364-day rate declined by 4.7 basis points to eventually settle at 16.86%. In the primary bond market, the auction for the two reopened infrastructure bonds was held on Wednesday, the 14th of August, and the central bank received bids totaling 126.3 billion shillings against an advertised amount of 50 billion shillings, representing a performance rate of about 252%. The central bank ended up accepting 88.6 billion shillings, and the results of the auction were as follows. For the 6.5-year bond with 5.8 years left to maturity, the central bank accepted 74.1 billion shillings at a weighted average rate of 18.29%, and this is compared to the bond's coupon rate at 17.93%. And for the 17-year bond with 15.7 years left to maturity, the central bank accepted 14.5 billion shillings at a weighted average rate of 17.72%, and this is compared to the bond's coupon rate at 14.39%. At the Nairobi Securities Exchange during the week, the equities market recorded a mixed performance, with the NSE 20 gaining the most by 0.6%, whilst the NSE 25 and the NASI gained by 0.4% and 0.2% respectively. And in contrast, the NSE 10 declined marginally by just 0.01%. However, their year-to-date performance remains positive, with gains of 16.6% for the NSE 10, 14.8% for the NSE 25, 11.4% for the NASI, and 8.9% for the NSE 20. The market's performance was driven by gains recorded by large-cap stocks such as Cooperative Bank, which increased significantly by 11.1%, whilst British American Tobacco and DTB Bank recorded modest gains of 1.9% and 1.3% respectively. This performance was, however, weighed down by losses recorded by other large-cap stocks such as NCBA Bank, East African Breweries, and Kenya Commercial Bank Group, which declined by 1.1%, 0.7%, and 0.5% respectively. On Kenya's national debt, according to the latest data obtained from the central bank, Kenya's national debt as at May 2024 stood at 10.43 trillion shillings, and this was divided between domestic debt, which stood at 5.31 trillion shillings, and foreign external debt that was valued at $39.3 billion, which is equivalent to 5.11 trillion shillings. For your information, Kenya's debt ceiling limit was converted to a debt anchor that is now set at 55% of the country's gross domestic product, and given that our current debt to GDP ratio is estimated at about 70%, this means that the government is in breach of its own borrowing target. Up next is our topical issue, and this week we are looking at the Treasury's domestic borrowing program. The Treasury is back on track on its domestic borrowing program for the current financial year. This happened after the auction of the two reopened infrastructure bonds that attracted a total of 126 billion shillings, out of which the central bank accepted about 88 billion shillings. According to the latest data from the Central Bank of Kenya, during the current financial year, the government is looking to borrow a net of 413 billion shillings from the domestic market, and this works out to a prorated monthly target of about 34 billion shillings. The central bank governor said that the government was looking to borrow a total of 773 billion shillings, out of which 413 billion shillings would be tapped from the domestic market, whilst the balance of 360 billion shillings would be financed using external loans. In the previous month of July, the bond auction raised a measly 10.3 billion shillings against a set target of 50 billion shillings. This dismal performance was attributed to the withdrawal of the Finance Bill for 2024 that caused investors to hold back on government securities. However, the August bond issue was heavily oversubscribed with a performance rate of 252%. This oversubscription was attributed to the tax exemption status of the infrastructure bonds, as well as the increased liquidity in the interbank market following the central bank offering 140 billion shillings in reverse repos during the past week. Investors were also keen to lock in the higher yields following the recent reduction in the central bank rate, which signaled a gradual easing of monetary policy in line with the global trend. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourselves a blessed and fantastic week ahead. And remember, when you want to help people, you tell them the truth. But when you want to help yourself, you tell them what they want to hear. Think about it. Thank you, and God bless.